Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, January 25th, 2022. I'm going to start out with the very short-term outlook. I want to reiterate my near-term bias stance or positioning in my active trading account, and also want to reiterate nothing's changed on my longer-term outlook. Those downside targets that I have on the weekly chart of QQQ and SPY, I still think there's a very good chance they'll be hit. No guarantees. We'll know a lot more probably within a day or so after the FOMC meeting. We'll see which way that goes and how the market reacts. But again, the charts pretty much dictate where things are going to go, yeah, especially over the longer term. And now we're really building up evidence on the weekly chart, sell signals, things like that. There's still some work to be done, longer term trend indicators that are still bullish, but I'll continue to update that. Let's just talk in the near term. I just want to reiterate what I mentioned this morning about my outlook for bounce. In fact, I even followed up on that post I got out to you this morning with an additional chart. Just saying that the post-opening drop from the that post I got out to you this morning, they sold off equities and I doubled down on it. Remember that one thing to expect right now, as we go into the day before the FOMC meeting, is that chop and slop I talked about. So that's I think that dip today was a buy. I said post-opening drop looks to be like a long side stop clearing slash short seller suck in move. I think there's a ton of short interest. All the I call them JCL, Johnny Come Lately shorts, piled in the last couple of days. You can look at the volume on things like SQQQ, huge volume spike and everything else. And the market doesn't make it too easy. The time to short was several weeks back. We had about over a month of many short entries with a lot of clean sell signals, very objective entries. But in the last few days, especially yesterday, no, not a good time to short, in my opinion, at least. Well, take that back. I mean, if you recycled it, hit the lows, and then recycled back in at the gap backfill, like I said, that was the minimum bounce target really for where to start scaling back in. But I'm talking. I know this gets confusing. I'm talking very active trading. So I speak to the long-term investor, trend trader. Nothing's changed. You're probably best sitting tight if you're not a flexible trader, and if you're an active trader, then that's what I said here. So, anyways, the near-term chart still look constructive with lower lows and lower highs since T1 was hit, as well as the PPO turning back up. So this is what it looks like, and I'll get to the updated chart here in just a second. That's it. So that was that wedge yesterday. Remember, that's when we hit the bottom of the T1 zone on the daily chart, as well as the sold T1 level on the weekly chart, right around the lows there, a little overshoot. Bullish falling wedge on this 5-minute chart, which was showed. And so this is what I posted today is so far, and this could change, keep in mind, and that's where we'll start to change my outlook. Right now, we have all the makings of a very near-term uptrend. Again, define your time frame. I'm talking a 5-minute chart here. This has nothing to do with long-term investors or trend traders or 401k money. This is active traders that just want to get in, hit and run, take advantage of the volatility, because it's times like this when the VIX spikes and volatility is high, and you have these three. Remember, yesterday was almost a 6-point round trip, 6% round trip turn in the Nasdaq 100, over 5% I think in the S&P 500, and so this is where active traders earn their money in very short order. But you got to be quick. I always say that, and when you're especially during corrections and bear markets, the moves happen fast on the downside. You can't be too late to get in, and much more importantly, you can't be too late getting out. You saw that yesterday. You gave back 5-6% on your shorts. Now, likewise, the rallies, the counter-trend rallies are strong as well, so you got to be quick on those too. So this is it, guys. I just want to point out, I circled these little, so far, as of now, and this could change, and that's where things start to change. When these other lows get taken out, doesn't eliminate everything, because that's still major support, remember, on the daily and weekly charts, because right around here, because remember, we overshot the targets just briefly intraday. So I'm still, at this point in time, just near term, looking for some near term upside today. I think the markets will. We know they've thrown that hissy fit I've talked about. So the big thing, well, Uncle Jerome Powell, console the market again and maybe cow down a little bit on his hawkish stance tomorrow. We'll see. And again, it's not about what he says or what the Fed does or say they're going to do. It's how the market interprets what they're going to do. So it's all about the market's reaction. But I want to point out too that this PPO signal line here, or the PPO line on the 5-minute chart, typically bullish when you're above the zero line, which I did a bad job of drawing there, but you can see what I'm going at. It's poised to curl back up. It looks at the PPO line starting to turn up. Hasn't made that cross yet, but if it can hold above there, then that will keep this at least this trend indicator intact, and that's when the the signal line, the last of the two to cross, is above that zero line there. You can see it cross. It's been pretty much for the most part with a little bit of whipsaws there. It's been trading below the zero line for a while and told you, hey, near-term trend is bearish. And yesterday it said, hey, the near-term trend is bullish. So hence the reason I'm long right now in my active trading account. So if that changes, those are things to look for. I'll let you know. But you need to be quick and monitor these things on your own if you are trying to game a bounce. And hey, if you're not, believe me, I've been in out on active trading account. And so again, if that's not your cup of tea, ignore this short-term analysis. So I'm going to get to some longer-term stuff here in just a second. Oh well, okay. That was a chart I posted about half an hour ago in the comment section under today's post. But here's the QQQ, same 5-minute chart. I just added a line here. You can see that's the same line I had on the futures. I'm going to go over that. There's that bullish falling wedge from yesterday, the breakout. And this downtrend line, remember I had on the futures this downtrend line. I told you there was a few reactions, 3, and we busted through it. And it's pretty much a perfect back test. And that's also, you can see they came in and there's those higher lows so far in QQQ. Now what does it need to do? Well, it needs to take out that recent high. And remember, the gap was already backfilled. So if it can get up through there and run at that again, it's still going to be resistance because it was, and now we have it was just simply because it was the top of the gap, and then we backfilled it yesterday, so you have a major reaction high there. As expected, that was what I was favoring yesterday after the close, is a pullback off that level, and gave it a little room today. And like I said, doubled down on my positions there, and I'll just scale out of those if we start to move lower. But I think we can probably run up here, and because we already checked that level once, I think there's a decent chance we could break through. So if so, these are near-term targets. But again, expect some chop and slop. And if it's not your cup of tea, take today off, take tomorrow off, wait until the FOMC meeting's out of the way. Know that you're going to have a tremendous volatility immediately after that. Market's going to shoot up or down and then go the other way. So don't overreact to the initial. Or don't put too much faith, I should say, or stock into the initial reaction. Wait and see how the dust settles. But again, we're going to let the charts be our guide. We're not going to react to what the Fed says or react to what the market does. We're going to be proactive. So if the market happens to rip up after the FOMC meeting into let's say a key resistance level, I'm just picking this one arbitrarily right now, 200-day moving averages and anything else, we'll be shorting that, or I'll be shorting that, and I'll tell you that would be an objective short entry. For example, market drops and breaks support, breaks below yesterday's lows with conviction. Well, we've already this is the reaction off T1. Let's talk about that again. Daily chart right there. There's the bottom of that first target zone. Let me make that a little bigger. I know probably sometimes you can't see these things in the video. There's the same chart I've been posting on the site, and you can always zoom in and expand those charts. There's that initial reaction. We hit T1, the bottom of it, and so far that's the reaction. Now the million-dollar question is, how long? Will we have more of a bounce? Will we consolidate around it for a while? A reaction can be, I define a reaction as either a bounce or a consolidation, or it can be a combination of both. If you look at relatively speaking, it's more of consolidation above it, a little bit of a bounce so far. But again, now that T1's been hit, I turn my focus back to the weekly chart, or parked right on it right now, poised to, we're on it. There's that doji. And again, to me, it's a matter of, there are no guarantees. Again, let me say that, but it's more a matter of when. And there's an if factor, let me just say that. But when this breaks, and we get the next leg down. So it's are we going to come back here, test that 40-week period moving average, which is the 200-day? That would certainly be an objective short entry. Are we going to back test the key breakdown level 370, roughly 379 there? Again, very objective short if we get it. I don't think that's going to happen for all the reasons I talked about. This is the market's playing out exactly as I wanted to see it. Impulsive, left a lot of longs in there, trapped, denied a lot of shorts because we went down so quick, so fast. So if you weren't already short ahead of time, those shorts want to be short now, and the market tends to not let those shorts in or let the longs out. That's the best kind of correction or bear market to trade, and so right now we've got that. But again, support is support until unless broken. Can't say that often enough. And the Fed on deck, so we'll probably grind around, chop around here today. Maybe take out the recent lows I just showed you on that 5-minute chart. Who knows? That's certainly possible. Maybe even test the lows. Again, anything's possible. All I can tell you is expect some volatility here and choppiness in the next day or two here. And whether you're a SPY trader or yes, you want to watch it because it is an index watched by many. So there's that same downtrend line. Again, I'm on a 5-minute chart just like I was on QQQ a second ago. Near-term downtrend line, that was yesterday's bullish falling wedge. That would have got you in early off the those lows that we had. Again, the case was there for a bounce. Ran up here. That's a level to watch right there, about 433.27. And there was the backfill the gap right there. Backfilled the gap yesterday just like QQQ as expected, and as expected pulled back, and that's it. So we pulled back at the trend line, take away everything else, and you have the key things to watch now. So far we have the early makings of an uptrend, lower lows and lower highs. That is the definition of an uptrend. You have the PPO above the zero line, and testing it, back testing it now. The zero line often acts as resistance when tested from below, and support when tested from above. So this is what, for the near-term bullish case, you want to see this happen. We just recently made a bullish crossover. That's why the histogram's there. And again, your targets are going to be something like this, and similar to QQQ, somewhere up there, give or take. Max bounce target. And we look at the daily chart. Remember, we took out the 200 days. We back tested them yesterday after being well below them. And so that may be it. We got what I was looking for. I said rarely, I've seen it, but rarely do you go right through the 200s like they're not there and not look back. It is very common when you're coming down from above, especially when you're way above them, to overshoot. And again, I call that a momentum fueled overshoot, but we already back tested. Now, sometimes you back test for a while. Sometimes you may even recover them, but all I can tell you is those are key levels to watch. And again, with the Fed on deck tomorrow, I don't expect a break of the recent lows. I think I'll just tell you what I expect, and that's not it. I think we'll grind around. I mean, if we broke them, it'd probably be marginal. Market usually just, especially after it's already made a big move, doesn't make a very big move in front of the Fed. A big meeting like the one we have coming up tomorrow. We just talk about a couple other of the recently highlighted trade ideas. Excuse me, and one of them would be Treasury bonds. I just want to throw this out there. I'm sure the majority of you listen to my voice probably don't even bother with trading them. If you're going to trade them like I do, futures are really the only way because you're leveraged up. You have to take a lot of TLT to make money on these moves because they're relatively small in percentage terms. And you can do that. You can leverage up, or you just use futures, which are inherently leveraged. Leverage is already built in to every single contract you take. But what I wanted to talk about is, okay, so I posted TLT as a long here recently in ZB, the long bond futures. A couple things to note. We have the PPO poised to make a bullish crossover. It hasn't done so yet, but it's turning up there. Let me add the histogram here. And you can see that that helps to define trends. There was a bullish cross right here, right? And boom, you got a rally. There was a bearish cross right here, and the trend changed, and we went down, right? So we just had a bullish crossover on the PPO. Let me put that away. You can see again, does a pretty good job of defining trends. We also came off support right there, and that's where we went long. I mentioned taking profits just the other day. There was some minor resistance there. Let me add it. I didn't have it on TLT, but I showed it to you on CB. So what you have here is a downtrend line and price resistance. There is a lot of overhead supply. In other words, there's this big sloppy trading range, but I think there's a decent chance that bonds could come up. Longer term, I've been very bearish on bonds. I think the long-term outlook is abysmal. I'm talking 401k investors, bond funds, things like that. But if we're active trading, there might be more upside, especially if the Fed. We'll see. Bond markets can do weird things. Sometimes they should do one thing, they do another. But here's the takeaway. We know the Fed's going to raise rates. It's more of a matter of how much and how fast, right? And if the market perceives Powell as being more hawkish, you might think, okay, rates going up, that's bad for bonds, Randy. That means Treasury, the T-bonds are going to fall. Well, no. Powell controls the shortest term rates, the overnight lending rate, short-term rates. So if short-term rates go up, long-term rates don't necessarily go up. In fact, I think they'll probably go down. That would be the most logical thing because rising short-term rates will put the brakes on economic growth. That's what's been driving this economy. Easy money, you can get car loans at next is nothing, and how mortgages. I just told you I refied. I bought a house not even 2 years ago and already refied it a few months back, locked in 2.5% on a 30-year mortgage. It's free money almost. Tax deductible 2.5%. Your after-tax cost on that mortgage is next to nothing. So, turn around and invest that money and you do other things with it. Anywho, all right. So I digress. But the point being that if short-term rates are going to go up and curtail economic growth, then that should lower long-term growth expectations and therefore drop rates, which makes bond prices go up. Remember, TLT is the price of the bonds. So that's what could very well happen there. So don't confuse the Fed raising rates with long-term rates going up, because the market will forecast and predict what long-term rates might do. And he's also, again, the key point is Powell's backed in a corner. He needs to put the kebab on inflation. And so there's two things that make long-term interest rates go up. Just two things, really. Growth expectations in the economy as well as inflation expectations. Inflation's running hot. See, right now there's talk of stagflation, which is falling economic growth, yet with inflationary forces on prices, and that's pretty nasty thing when you have low growth or contracting growth in the economy and inflation. But either way, there's a lot of cross currents. I could sit here, I'll talk all day on it, but there's your line right there. If TLT pops that, we may see more upside. So let me just revisit the chart. Here's the ZB for the futures traders. ZB is the 30-year bond futures, and there was that divergence right there, bullish divergence, and then we broke out. I said we had to break above 154.200 to run. We broke out. We also took the trend line, ran up, but at that point said there was some negative divergence there and an uptrend line. Said, look, I'm going to just book my profits, even though it's originally shooting for that 157.0. And we pulled back, and now we're having another thrust up. So the correction's already happened. That's my point. We had the correction off the divergent high, helped to take care of what needed to be done in the charts, in other words, with the divergence. And we're moving up. And so we've already broken the trend line and had a correction. And again, that should open the door for a move up there to that 157.094. And if you're trading treasuries, you want to let it run. This is pretty good support. I think we need to remain above 154.200, so you can have stops somewhere in there. If it gets really ugly, and again, I can't say this enough, the Fed is tomorrow. You're going to see volatility in just about everything related to interest rates. That's the stock market. That's certainly bonds, treasuries, corporates, munis. It is the currency, Forex. Expect volatility in the U.S. dollar, and the euro, gold, silver, platinum, palladium. Let me give you a trade idea that reminds me of palladium. I'm remain long and bullish the metals in my core accounts, long-term accounts, gold, silver, and associated trades there. And I'm digging up for you palladium. I think it might be time. for a potential short trade. Where did my palladium chart go? That's platinum and platinum. Here's palladium PA. All right, this is a 3-month chart with hourly candlesticks. And here's what I wanted to show you. We've got a little minor uptrend line right there, forming this little wedge right there with negative divergence on the 60-minute chart. Last time we had a wedge right there, broke down, we back tested it, and then there was a nice correction to be had. Just like we had positive, aka bullish divergence at that low, gave you a rally. That rally ended with, yep, you got it, divergent high, correction. So there it is. And we're at resistance. There's a previous reaction high here, and I think if I take it back to 6 months, we can even see more reactions on that line. Yep, there it is. All right, so about 2141 or so. That seems to be resistance, or has been. We had a divergent high there and a correction. We rallied into that resistance again with negative divergence, actually bigger divergence here on this 2-hour chart, and we had a big drop, and that set up a divergent low. Right now we have almost divergence here. It's almost slightly higher high there on the RSI, but pretty much flatline divergence with there's your divergence line and slightly lower low on the PPO. So palladium, which is PA for palladium futures, or you can trade PALL. These are potential targets. Let me show you PALL for your ETF traders. Oh, nope, PAL. And palladium was also at resistance. This is a line I've had here, goodness, since I created that line back in April 1st of 2020. That would have been somewhere in here. So it was I put that line there for, oh, I can't remember. I've had so many trades on palladium, longs and shorts, bullish divergence, negative divergence. Shorted it back here, I guess, off the divergent high. But either way, all right, let's forget about the past trades. Did have a back here on the August 31st video. I made the case for a long-term, longer-term bearish case on palladium, and posted as a short right there. We nailed that short. Then right here, covered it. Mentioned that I showed you on the 60-minute chart. Even here on the daily chart, we had positive, aka bullish divergence. We fell to support, and I said it would be a bounce trade, and we did that. And I think we hit our target perfect. I think it was a near perfect play of that drop, and then that a reversal, and then to get back short again. Now we're back to that level. That's what I wanted to mention. It's still resistance, and if it wasn't resistance when I created the line back in 2020, it most certainly is now, because we had two distinct reactions right off that level. If we go a little higher, which is possible, 210, about 211 is even as good, if not better, resistance. So equally as good, let's just say. So that's it. We're coming off a divergent low right there. Again, maybe that was the last time I mentioned it as a long side setup, but I think that divergence has ran its course with this rally there. So anyway, there's a trade idea for you. Where to swing it to if you're going to trade it here. A little reaction high there, but at minimum I think come back down to 172.11. And I still am longer term bearish, even though as a whole I'm bullish on commodities and precious metals. Palladium I think just went too far too fast. Long term charts look to me bearish. And remember, the single biggest use of palladium is in emissions control, catalytic converters, things like that. And here we are yet with the biggest push away from fossil fuels to clean burning vehicles. Honestly, I don't know how much palladium demand will be in electric vehicles. There's probably some. I don't know. I just know that there's a shift away from combustion engines. So anyways, that might speak to the longer term bearish fundamentals if that drop in demand from that aspect overwhelms any increase in demand from EV cars. And lumber looks good. We continue to get paid on that. I think we're down about 19% since the breakdown there below the bearish rising wedge. And coming up on that 990-ish target right there, but I still think we'll work our way down closer to that 861. This is where I think it'd probably be safe to cover a little bit above there, around if we get down there. But we're oversold. But again, that's the nature of this beast. It just keeps getting oversold when the trend changes. About 900 or so, you might want to be safe and cover if you want to cover a little early. Or when you get close to that level, if we do get down there, whether or not we have a reaction off 990, is just trail your stops down. And this one's a little quirky, harder to trade. It shuts down overnight. It's not a 24-hour trading commodity like a lot, and it doesn't open until 10 a.m. So your hours are 10 to 4 Eastern time to trade it. And so it's a gappy little sucker. You can see by the chart there. So just keep that in mind too. All right, before I wrap up, I'm going to wrap up here, but I kind of doing this backwards. I should have done this first. I want to just go through some of the market-leading FANG stocks and show you where we're at, because that's certainly germane to what's going on in the market here. So you have 157.31. That was a key all-time high and a divergent high on Apple. Apple broke out right there, back tested it several times for about a couple weeks, and boom, we pulled back to that level. So there's support on Apple, and that's why I don't see, anything's possible. And when it breaks, and I think it will break, we'll continue down to my next targets. But as of now, this is the most beloved stock on Wall Street. I mean, this is really the holy grail of stocks to a lot of traders. And I know they're foaming at the mouth to buy it after a 15% drop. If they don't, then it just shows you there's an overwhelming shift of supply-demand dynamics. They stepped in a little bit yesterday, but we're at that level again. So the bottom line is, whether I think it will break ultimately, it's just when does it break? And we're at that support now. So that's why I think, I think between now and tomorrow, probably going to flounder around here. I don't know if the buyers are going to come in aggressively. Probably you're not going to see a whole lot in front of the Fed, but if Apple bounces 167.55, and if you're an Apple bull, I'd be buying it with both fists here. Put a stop below yesterday's lows. That's support. Otherwise, if it takes that support out, you're probably going to go down to my next target. I think that's going to happen before, whether we do this first or not. But that's Apple at support. That's the bottom line. Microsoft at big support as well. We're on the daily chart on all these. That's a big level there. We broke out, back tested it for a while, checked it again, another back test there, and we fell to that. That's a line I've had here for a while, 283.10. Remember, we already got my bear check marks. I had these yellow lines. We took out that one, we back tested it, and then this was the one that I really wanted to see. I said would be the nail in the coffin line. Boom, and that broke there, and that's where you had that waterfall selling. So these lines paid off well. We watched that yellow line. Remember, early signal came when the yellow lines up here were broken, the uptrend line and that. So all along, we've just been getting check marks, check mark, check marks. And the thing is, this is a key level. So I should probably color that up now, but I'll just tell you that's it. Yesterday's low, we overshot, but the support's around 283. And if it takes that out, and I think it will ultimately, Microsoft's coming all the way back down to about 228. So that's another 22% drop from where we're at now. We're also right on the 200 days. We're testing those from below. 200 simple and exponential. But here's the takeaway. Microsoft is sitting just above support, but kind of pinched between that. It's also just below the 200-day moving averages. Alphabet, I have two share classes. Let me see which one I want to cover with you. That's GOOGL. There's GOG. That was the one I was showing you before. I gave you the yellow line, and that was it. So when that went, all my FANGs have taken out the yellow lines. Those were those, I won't say final, but kind of, they were the final check marks I was waiting for in the last few weeks. And they were all taken out, and they've been taken out with conviction. So to me, it's a matter of, do we back test or do that, or just do that right after the Fed, or maybe a little higher back test. But whatever, these were major check marks for me. We're still below the 200-day moving averages. So I'm still, as a swing or trend trader, in short the rip and buy the dip mode. In other words, you can short rips back to resistance, and that's why I'm going over all of these. And ideally, instead of just watching QQQ or SPY, watch both of those, but also watch these market leading stocks, because the more of those that break down, or the more of those that are back testing major resistance levels that were former support levels that were just taken out, the more you have back testing at the same time, the better your odds are you're going to get a rejection off that level. So that makes it an objective short entry there with a stop somewhat above. Amazon's at pretty decent support, but it already took out my yellow line that I wanted to see. So again, to me, it's a matter of, is there a little more upside before the next leg down, or do we just consolidate here and then do that? There are a lot of trap longs in there again, and the fundamental landscape is shifting and is likely to continue to shift, meaning we're looking at a rising rate environment in 2020 and quite likely beyond. Tesla took out the yellow line, but right on that 905 support. So again, that's the common takeaway here, is where all these major market leading stocks are at support. We've broken some support levels, but that's already been reflected in the nice drop that we had, that we profited on the short side lately. Now they're at support. If you want to be long-term bull, this is possible. You see big divergence forming here, positive divergence on Facebook. Again, if you are a bull, step in, and that's why I'm right now. I'm in the very near term. I prefer to be long versus short, because I think the buyers are going to buy here. They almost can't help it when you pull back to a key support level like that, and the bounce in like Facebook, for example. Here's a level. I'm going to move this line right now that I had here. That's the level. That would be a nice shorting up or a bounce target if we get there. If this bounce gets a little traction, 323, it was big support right there. Based on this divergence, we could come all the way up here and still, and then reverse and still be in early stage bear market action, because the top was back here. And remember, a lot of these stocks already fell quite a bit. This is 24% drop. So if you want to call it a bear market, I don't. But the mainstream media would call it that, because it's a drop of over 20%. Anywho, big levels to watch, guys. That's the takeaway. We're at support, so no reason to be aggressively short right now. If you want to be long, the active trader like me want to game a bounce, great. Just don't get married to it in case these levels all start to go when we drop through those support levels, because that's probably when the next leg's going to come, whether that happens tomorrow or 3 weeks from now. All right. One other one I wanted to update. I'm going to jump down the list here. I'm going through these in waiting in the NASDAQ 100. Is Netflix. Netflix is still in close proximity. It's a little below my golden shorting line that I talked about when I mentioned as a long the other day. It was a zone that we were shorting back here. A lot of those shorts were to the bottom line there, and there's the top line. So that's where we're at right now, and we're a hair below it, but not by a large margin. This is, again, I threw it out to you as either a hedge. So far, it's not doing much, or a pure play long if you're bullish. Otherwise, if Netflix can't recover that level soon, it's probably going to go a lot lower. And, based on my weekly chart, we had big multi-year divergence. We took out the trend line right there, and it hasn't looked back. It sliced right through what was great support right there at about 475. Didn't pass go, didn't collect $200, didn't even look back. Right here, 387.40. That's that next support. And again, I would be surprised, not shocked, but surprised if we don't recover that level soon and at least consolidate around there. And if by chance the correction in the market is over and we're going to go to new highs or even get close to revisiting the old highs, I think Netflix has more upside than a lot of the other FANGs that are covered there. Okay, and I will wrap it up here. And if I see anything else that stands out, I'll get it out to you. Otherwise, let's just prepare for some choppiness in the next day or two, and then we'll pick it up after the Fed. Of course, I'm not. I'll be around. Just wanted to say that. But again, I don't expect or wouldn't position very heavy, long or short, until the Fed is out of the way. This has been Randy Finney with Right Side of the Chart. Have a great day.